everyone, I'm Joey. Today I'm going to be sharing with you how the stock market works and how investors make money using the stock market. Disclaimer, I'm not a financial advisor or a certified financial planner, and all of my views expressed in this video are purely my opinion and for entertainment. When I first heard the term investor, I would think of some super rich guy who works on Wall Street, but the reality of it is we can all be investors and we all should be investing into ourselves and for our future. There are three main types of investments: stocks, bonds, and cash equivalents. Stocks and bonds are a great way to grow your money over the long term. Cash equivalents are basically just about keeping your money safe. That's a different video for a different time, so you can go check it out on my channel if you're interested. In this video, we're going to be focusing specifically on 6 types of investing in stocks and bonds. Don't forget to like this video. It really helps our channel and it helps other people find this information as well. If you want to test out the stock market and see what it's all about, but you don't want to invest any of your own money into it, check out the links that I have in the description to Robinhood and Webull. These are 2 different apps that you and I both can get a free stock just for opening a free account with them. The stocks can be valued up to $1,200. Even if you wouldn't consider yourself an investor, a free stock is a free stock. Let's get started. First off, what is the stock market? Let me put it to you this way. I started a single member LLC, which is a limited liability company, about 8 years ago. I am the only owner of this company, so this is a privately owned company. It's a small business and I don't plan to make it a huge business, so it'll probably stay private for the entirety of its lifespan. Just about all companies start as small, privately owned companies. As a company gets bigger, they may need to raise money for expansion. At this point, this company can go public. Once a company goes public, anybody with an investment account and access to the stock market can purchase a share of this company. Just about anybody can open up an investment account and that makes them an investor. Investors can purchase just about as many shares of this company as they like. This newly public company is now going to use all of this investment money for expansion, and its goal is to make more money. And that's how investors make money with the money that they already have. The prices of these shares are going to fluctuate and go up and down on a daily basis. Warren Buffett's basic principle with the stock market is buy low and sell high, which is a good philosophy in just about every area of life if you're trying to make money. For example, a car depreciates in value. That means you buy high and you sell for less. Vehicles are not good investments. We need them to get around and they're incredibly convenient, and that's why most people have them, but vehicles for the most part are not good for growing wealth. So like I said earlier, stock market share prices fluctuate up and down every single day. That's why you see these jagged stock charts that look like a polygraph or lie detector test, and they're all over the place. It makes it very scary when you're first investing to look at that and not really know what's going on. Although on a daily, weekly, or even monthly basis, the stock for a company could look completely crazy. However, in the long run, over a year or 5 years, 10 years, 30 years, that graph is slowly increasing. Good stock investments yield between 8 and 12% annually. That means if you invest $100 into a stock, you're going to earn $8 to $10 that first year. The money that you invested in the beginning of the year is now worth $108 to $112. Now for the second year, your investment starts at $108 to $112. Let's call it $110. If you make another 10% that next year, that's $11, because 11 is 10% of $110. So at the end of 2 years, you have your initial $100 investment, you have $10 that you made the first year, and you have $11 that you made the second year. It keeps getting bigger and bigger because your investment keeps getting bigger and bigger. Compound interest can work really well for you, as in stock investments, or really badly against you, such as credit card debt. First things first when it comes to growing your wealth, get out of debt and stay out of debt. Debt can be absolutely crippling because the compound interest works against you. By learning more about different types of investments, you can learn how to make compound interest work in your favor. So those are the basics of the stock market. I'm going to share with you 6 different types of stock market investments, the differences between each one, and how you can grow your wealth over the long term using these avenues. These are long-term investments. If you're interested in learning about penny stocks or day trading, that's a different video for a different day, so go check it out on my channel if you're interested. The first type of investment you can make into the stock market is through stocks. Depending on the stocks you buy and which companies you invest in, your investment could lose value, so be careful and do your research. In this day and age, we are in the middle of the 2020 coronavirus pandemic quarantine. The stock market has just crashed, but you know what companies are doing really well? Internet companies like Google, Facebook, and streaming services like Disney, Netflix, Amazon, Roku. I'm not telling you to invest in these companies, but you can gain a lot of insight onto how a company is doing with what's going on in the world and how these companies are reacting to it. My tech company stocks are increasing in value at this time faster than other companies, but that's just because of the world we live in right now. In a couple months, hopefully everything will even back out, but a good way to figure out some good stocks is just to talk to some people who have been trading stocks longer than you have. Some basic research that you can do on your own is look at a company's stock graph over the past 5 years. How does that graph look? Is it increasing? Is it decreasing? Can you not really tell what it's doing because it's so volatile? For long-term investments, look for stocks that are increasing over the long term. Once you've done some research and you found a good stock that you want to invest in, look at that stock's graph for the past week, month, and year. Looking at the shorter timeline graphs, pick a price point that's on the low end and purchase that stock when the share price drops down to that level. Remember, on a daily basis, the stock market goes like this. If you buy that share at a high price point, there's a good chance that that price will drop and you'll lose money right off the bat. If you're looking at the stock graphs over the next week or month, try to buy when the price point drops down to a lower price point so that the next move of this stock is up, not down. This is not a foolproof plan, this is just an example. Hopefully it gives you an idea of what Warren Buffett said when he said buy low and sell high. Robert Kiyosaki from Rich Dad Poor Dad also put it this way: profit is made in the buying, not the selling. He was referring to real estate investments, but it can also be applied to the stock market. I encourage you to read Rich Dad Poor Dad if you're interested in learning more about how to make profits when you're buying. The second and third type of investments we are going to talk about are mutual funds and index funds. These two are very similar. The main difference is a mutual fund has a money manager behind it who decides which companies are going to be a part of this fund, picks the stocks or bonds, and actively manages it. An index fund does not have an active manager. When you buy an individual stock, you're buying a share in one company. When you invest in a mutual fund or an index fund, you're basically putting in a chunk of money and spreading that money evenly over a bunch of high growth companies. This is generally a safer investment because instead of investing into a single company, you're diversifying your wealth over a lot of different companies. Not all of these companies are going to be growing at the same time, but that's what makes it a safer investment, is because the companies that aren't doing so well are hopefully carried by the companies that are doing well. The fourth type of investment is a bond. Bonds are an even safer investment, however they yield a lower interest rate because of how safe they are. Bonds are basically a loan that you give to big companies or the US government, and these companies or the government will pay you interest for investing your money with them. Someone who buys bonds can earn income through the interest payments from the government or these companies. These bonds have a lifespan that these companies or the government will pay you interest for that amount of time. You can also receive back your principal investment. You can also sell the bonds at any time for a higher price and hopefully make some money off that. Again, for the most part, bonds are a safer investment, but they yield less interest. The fifth type of investment is an ETF, which is an exchange traded fund. ETFs are very similar to index funds in the way that they don't have an active manager. However, the main difference between an ETF and an index fund is that an ETF gives you an option to buy into this fund at any price point during the day. Mutual funds and index funds only allow you to buy at a specific price point at the end of every day, excluding weekends because the stock market's not open on weekends. Number 6, the last type of stock market investment that we're going to be talking about are options. Options are a contract between an investor and a company that basically says this investor will buy 100 shares of this company by a certain date. Buying an option is quite literally an option. Don't forget to check out the links in the description below to Robinhood and Webull to get your free stocks. It's free to open an account through both apps, so you might as well get a free stock while you're doing it. Remember, these stocks can be worth up to $1,200.
You can learn a lot from my mistakes by not trading risky stocks in your retirement account. When I first opened up my retirement account, I didn't know any better. This was my first time accessing the stock market, and so I put a chunk of money in and just started trading random stocks to figure out how the stock market worked. I got pretty lucky doing this because I read some recent articles about a stock that was slowly exponentially increasing. I still have no idea why this was happening. I just read the stock and immediately bought the stock. It was really lucky. I ended up making a couple $100, and so I got a big head about it. Remember, all of this time, this was in a retirement account, not an investment account. In my opinion, retirement accounts should have long-term growth in mind because we're not going to be touching anything in our retirement accounts until we're retired. I was trying to get a feel for how the stock market worked, and so I just immediately started trading random stocks in my retirement account. Well, I heard about this Chinese electric car company, and I support Tesla, and from what I knew, it sounded like Tesla was doing pretty well at the time. I support more environmentally friendly vehicles, so between my retirement account and my investment account, I invested about $26,000 into this company. When they first went public, I bought a bunch of their shares of stock for about $6. The stock price ended up going up to $12, and I held it because I thought it was going to keep going up, and then it crashed and went below $6. I could have made a lot of money by short selling this, but I got greedy and it ended up being a lesson learned. What I tried to start doing in the beginning was to keep buying this stock at a lower price to lower the average cost of each share price, but by doing that, I was just investing more money into a company that I didn't know was going to succeed or not. After I had tried this strategy for a couple months and the stock price still was not coming up, I decided to cut it out and stop investing in this stock because I was just losing money on it. I put $26,000 into this electric car company and the share prices have dropped, so I have lost about $12,000 on this investment. So this is just gonna have to be a waiting game for me for this stock price to come back up so that I can actually take my money out and not lose any money. If I really need to use that money, I can take out $14,000, but that's acceptable accepting a $12,000 loss. So instead of accepting a $12,000 loss, I'm just gonna hold this stock and not do anything with it. A lot of it's sitting in my retirement account anyway, so I'm just not gonna look at it because it depresses me every time. But one of two things are gonna happen over the next couple years. The company's gonna go out of business and I can forget thinking about it. That would suck, but at least I'm not waiting around for my money to come back up again. The more opportune option would be that this company steps it up and kicks it in gear and gets some of these electric cars sold so that this price can go back up. It's been kind of wavering between $1.50 and $3.50. I'm hoping in the next year or two it'll come back up, but who knows? It was a mistake in the beginning and you'll make mistakes too in the stock market, but hopefully you can learn from mine and do better research, because a lot of investors view the stock market as kind of a game just to figure out where you can get the highest yields. Don't forget, sometimes it takes losing a little bit of money to learn how to make more money. If you're investing in a retirement account, put your money in a good solid mutual fund or index fund or ETF, and don't trade individual risky stocks. That's just my opinion. I'm not a financial advisor, and remember, all of my videos are just for entertainment. Hopefully this has given you a quick overview of what the stock market is, how it works, and maybe some ways you can learn from my mistakes. Don't forget to like this video. It really helps my channel, and it helps other people trying to learn about the stock market find this information as well. And subscribe to my channel for some more personal finance videos. I'm Joey. Thanks for watching. Talk to you later.